Hey there everyone, it's Joe from Ainslie's Gold Silver Standard Insights, brought to you by goldsilverstandard.com and ainslieBullion.com.au. Today's topic is 98% of CEOs are planning for a further recession. Now that's posted on the Ainslie website. I'll put a link below for you to follow along. And of course, we have Chris Tipper here to break down the morning's news. And joining Chris today is the author of said news and regular Ainslie team member, Branko. So, Branko and Chris, over to you.
Thanks, Joe. It seems like the impending recession is a certainty now, at least according to the latest surveys of CEOs and Bloomberg economists, who now predict 100% chance of a recession in the next 12 to 18 months. That was the focus of the news piece out today and can't be ignored, especially when listening to the CEOs, who are the closest to the ground in terms of knowing what their business conditions are currently and those of the suppliers and customers that they deal with. Branko has completed the deep dive on this for us today, as well as the likely flow-on effects for the housing market. So welcome back, Branko, and thanks for joining us today to go into all of this a little bit further.
Thanks for having me. Good to be on.
So my first question around the news that you put together today was those survey numbers. Okay, so we've got 98% of CEOs predicting a recession, along with that quantitative Bloomberg model, which was saying 100% probability of a recession coming over the next sort of 12 to 18 months. So obviously these are very strong numbers and show quite a bit of conviction. But can you justify numbers that strongly? Because it concerns me, for example, that CEOs are that bearish. You'd like to think that, as I just said, that they'd have real-time information because they're actually working in their businesses. So what do those numbers sort of say to you?
Yeah, I think it is very concerning to see numbers this high. And I think it's rare to have business leaders agree on anything, but to have such a large number, like 98%, that's, worth paying attention to. And then to have a more quantitative model as well, like that Bloomberg model, predict 100%, it kind of shows you've got the numbers and the more intuition feel, like the CEOs both agreeing. So that kind of makes me feel like this incoming recession could be significantly more impactful than we're thinking.
Mm-hmm.
And then also, kind of the secret of all this, we've kind of already had a recession. Even if the US president kind of tried to change the numbers, we kind of already had that, back-to-back negative quarters in growth. So we've kind of already had a recession, and then they're expecting a greater recession in the future. So given the confidence of both people and the model, it's quite significant, I think, as an overall,
that overall perspective, and I can agree with you there that when you look at that sort of level of conviction, that's concerning. I think the flip side of the argument, and the one that I'll no doubt hear a lot when I talk about this with people, is that you need to take the contrarian view. So they'll be sort of saying, well, but if everyone's bearish, then that's where you look for signs of a bottom. But I think maybe this is a little bit different when you're talking about numbers, because this isn't speculators in the market. This is real business people saying, like CEOs of companies saying, well, we think we're going to have to lay people off, or we think we're going to have to adjust our prices or things like that. Is that correct?
Yeah, and I think we could see some kind of compounding effect here where, rather than like, for example, the markets, if there's like a very one-directional bias, often the opposite could occur. But in this case, it's almost like we could see a compounding effect. So the overall is a lot worse, because if every business across the board is forced to lay people off, it's going to be much bigger than in their individual bubble.
Yes.
So we're going to see an overall economic compound where it's going to be worse and worse and worse.
No,
if everyone acts the same way, which is 98% are planning to do so.
And that's where it's concerning, with those numbers all being on the same side. So digging a little bit deeper into that, but from a slightly different angle, how are you seeing businesses preparing for this recession? So is part of the problem that when you expect a recession, sort of what you just said, individual businesses might create a self-reinforcing cycle then? So if you're expecting it, does it then mean that they operate in a way that actually creates what they're expecting?
Yeah, so the first most obvious way that businesses are planning for this is that, a recent PwC survey kind of indicated this, was that 50% of businesses are expecting significant layoffs this year, and 83% are going to turn towards more streamlined automation. That's the first and most obvious point. But then also I think there are other things that we could see, like, businesses might not grow at the same rate as well. They might kind of restrict growth and just maintain what they've got going on now in fear of the future. So that restricted growth and push forward into new areas, it's going to have ripple effects as well. And then you could also see, we're also seeing tech companies like Microsoft lay off more people too. And then also we could see businesses, diversify their holdings, like we saw recently with the famous CEO, I'm going blank on his name, hedge fund manager, Ray Dalio, I think his name was. Yeah.
Ray Dalio, yep.
Yeah, Ray Dalio. He invested a lot in gold as a way of diversifying his portfolio. So we could also see a lack of investment in different financial industries. I know crypto, for example, there's a distinct lack of investment in Web3 at the moment, and probably there'll be a distinct lack of investment across different venture capital and high risk areas as a consequence of businesses preparing themselves.
Sure. And I think there's something we need to think about here as well, that these are not quick. So when I know something that I was reading recently was talking about letting go of employees, and that's the very last thing that you do. So if you're starting to see the job numbers, and the example actually is today, just this morning, we had the Australian unemployment rate stay absolutely steady at 3.5%, the same as it was the previous month. And you go, well, we're not seeing any sign of people letting people go yet. So is there any recession there? But letting people go is always the last thing you're going to do, because it costs a lot of money and takes a lot of time to build those people up in your business. So you don't see these things flow through straight away. There's a delayed and lag effect. So that's something I suppose we need to be thinking about as well when we're talking about this. It's not like all of a sudden we're going to see a massive unemployment rate. It's something that builds. And the flip side of that, at the other end of the recession, it takes a long time for that to slow down. So you might still have job losses showing up in the data after the recession's over, simply because it's of that delay.
That's a good point. I think we saw that kind of in reverse, where came out of this big, I don't want to call it an economic boom, but with low unemployment like we have now, even though the economy is doing quite badly, it is taking a while for the unemployment number to catch up. And it's kind of holding steady, even though the economy is struggling. So it kind of works in reverse, where we could see this flat lining, even though the economy is bad. And then, like you're saying, also the revert the other way, where once the economy is at its low point, those numbers could just keep piling down.
Yeah, absolutely. So switching now a little bit to the housing market, because that was something that you looked at in the article and in your research today. So what are you seeing as some of the signs of economic pain there that are already starting to bubble up? Because I know that's something that we, particularly in Australia, are really focused on.
Yeah, and I think the importance of this in Australia in particular is, we have I think we're either number one or number two, one of the highest in the world in terms of household debt. So we're at a particular vulnerability with the way our house prices are. I saw recently, there was it's a bit off topic here, but I saw an apartment in Potts Point that was being rented out for about $550, and its toilet was in the kitchen.
Yes.
So it's quite extraordinary that's going.
It's concerning that that's allowed to happen in the first place, but yes.
Yeah, the studio apartment $550 a week with a toilet in the kitchen. That's the state of the Australian housing market for you. So we're particularly vulnerable because of our high prices. But then also, I think it gives a good reflection onto what the average Australian is going through. And I think that if a recession were to occur, that's the number one place where it would impact the most, similar to how we saw in 2008 in the US, where people were defaulting on their loans and having to be foreclosed. So that's why I looked at that to start. And there's some concerning signs. For example, roughly 8% of homes had a decrease in value over the past 4 weeks. So it's like a rolling average.
Yep.
So it's kind of a closer, more in-depth, rapid look of house prices. So that's quite concerning that 8% of homes dropped within that 4-week period. And then, you've got lots of data that really support a negative market. And I think the concern is that with the way the Fed's going, that's going to be compounded. So we've already seen 51% or mortgage rates go up 51%, which is a huge blow for houses. And that's going to continue, most likely, given what they're saying at the moment. So something to consider for sure if you're a homeowner, it's those increasing rates you're going to be seeing.
And we've talked about that before too, because when we mention delay effects for unemployment, it's the same with the mortgage repayments, because I think the lag was somewhere along the lines of 3 months before you actually start to see those increased repayments showing up, because banks have to pass them on. There's notification periods where they have to tell you that they're raising the rates. And then by the time it actually impacts your spending, it might even be 6 to 12 months later before you realize that you don't have any money anymore because your rates have gone up. So yeah, that is quite important. So sort of wrapping this all up together, how do we, from your perspective, deal with this as individuals? So if we see a recession is on the horizon, we've got very strong signs coming from CEOs, from models, economists, everyone sort of predicting that's the case. What do you think? What are some of your recommendations of how individuals can best place themselves to deal with that?
Yeah, well, obviously not giving financial advice or anything, but I think it's important to have a plan in place, because like these CEOs are saying, they're already planning their businesses. So as individuals, we need to plan what we're going to do, right? So it could be a range of options, like China and India, for example, are buying a lot of gold. That's what they're doing right now.
Mm-hmm.
At an individual level, if you're a homeowner and you're looking to maybe refinance or take on more debt, you might want to rethink that, or bake in a greater interest rate in the future. That's an obvious one, right? If you expect rates to go up, just bake in a much higher interest rate that you'll be paying to ensure you have enough savings to cover that. That's one way. Diversifying your portfolio is another way. Maybe just staying in a more stable job at the moment as well. Maybe not taking a risk with your employment right now because you expect kind of a further recession. Mm-hmm. So I think the important aspect is, as individuals, we need to have a plan, and we if we are expecting, which I think most people are, we are expecting economic pain, we need to have a plan to kind of attack that in the best way we can. And that's just probably being a bit more conservative right now and taking a step back, looking at the situation and just taking it all in.
And I think that's excellent advice, particularly around the risk taking, that you go, well, you say you're not overly happy with your job. Do you just leave now? That's what a lot of people have done, but it's been really easy to do that. If all of a sudden you're faced with difficulty in finding additional work, then maybe that's not the best time to do it. So that makes a lot of sense to me, how you sort of recommending just being a little bit cautious and paying attention. That's all you can really do to protect your self through that really aggressive period of time. So
absolutely.
Thank you very much for all that. Lots of great information in there today. So always appreciate having you on and the work that you do in putting all this together. So thanks again, Branko.
Thanks for having me. Good to see you.
Thanks so much for being on the show again, Branko. And Chris, I'll see you on the next one. And for the audience, head over to the Discord channel. That's discord.gg/gold. The perfect way to continue the conversation. Chris and Branko will be there for the next 1 or 2 hours after the upload of this video. So head over there, ask your questions, get a response, and tell us your feedback. We really want to hear from you. I always want you to subscribe to the YouTube channel, youtube.com/Ainslie Bullion, for the wide range of informational videos 5 days a week, including specials and more. And while you're there, head over to goldsilverstandard.com. That's bringing gold and silver into the digital world. As we say here at the end, balance your wealth in an unbalanced world. Take care, and we'll see you next time.